Hello and welcome to the April 2021 Investment Outlook webcast from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author, Tom Stevenson, to find out where Tom thinks markets are now and where they may be headed in the months ahead. Tom, hello.
Hi there, Ed.
Now, Tom, as we head into the second quarter of the year, we've had an encouraging start to 2021 from an investor's point of view. Would you say that expectations are somewhat higher now than they were at the time of the last outlook back in January?
Well, you're right, Ed. I mean, certainly markets have continued to move ahead in the first 3 months of this year. There's probably less uncertainty than there was back in January. We had the Brexit situation, of course. The US election was technically unresolved at the beginning of January. And of course, we'd had the good news on the vaccines in November, but it was still pretty early days in that process. So yes, I think probably a bit more certainty about the outlook now than there was 3 months ago.
Okay, well, we're about to hear your analysis, Tom, of where markets and the different asset classes are right now. We should say at this point that what you say is not investment advice and should only be seen as guidance. There's a second part to the webcast today as well, which is a Q&A to answer some of the questions we've received in advance of the outlook from Fidelity investors. I'm pleased to say that we had a great many questions submitted and we're going to come to those very shortly. But before that, let's hear Tom's views on the current outlook for investors.
Well, here we are, a year into the pandemic, and what a year it's been. If someone had told us 12 months ago that we would have recovered all the losses and more, that we would have enjoyed the best one-year period for shares since the Depression, we would certainly not have believed them. As the chart here shows, markets have not just regained their losses, they've put shares back onto their already impressive growth trajectory. It really is as if the pandemic never happened. The last 3 months have actually been dominated not by stock markets but by bonds. Although shares have continued to move higher, the pace has slowed. The real story has been in fixed income, where bond yields have started to move higher as investors feared the return of inflation. It's important to see this move in the context of the past 40 years, though. Yes, yields are rising, but there have been plenty of false dawns in the past 4 decades. This may be a watershed moment for markets, but it equally may not. Sometimes we learn from history, sometimes we get caught out all over again. 3 months ago, I warned that the renewable energy sector was looking frothy. Green technologies are undoubtedly the future, but the price you pay matters too. And this is what happens when investors don't pay attention to valuations. The bond market may or may not be at a watershed. Stock markets, though, definitely changed direction in November last year, with a long-awaited rotation from growth into value, as optimism about the end of the pandemic was triggered by the first successful trials of vaccines. The rollout of vaccinations has not been even around the world. Here you can see who's winning this particular race. For once in this pandemic, we've got something right here in the UK with a higher vaccination rate even than the US. That's feeding through into hopes for economic recovery and to varying degrees into stock market performance too. For a few years now, I've been making New Year fund picks from our Select 50 list of preferred funds. This quarter, I thought it might be useful to look back at how the picks from earlier years have done. They're not just for 1 year, and I've kept my holdings in all the earlier picks in my portfolio. The next couple of slides show 2 recent years' picks. Here is 2017. You can see the importance of putting your eggs in a variety of baskets. Rathbone Global Opportunities has done massively better than the other 3 picks from that year. But overall, the message is that buying and holding pays off. You never know when a style will have its moment. Fidelity Special Situations has certainly rewarded an investor's patience in the past 6 months. The 2019 picks show even more clearly the importance of sticking it out when things get dicey. You can see the pandemic plunge only too clearly here, but it's clear also that over the whole 2-year period, the picks have done pretty well. Once again, the global pick has done the best, which might say something about the wisdom of leaving the geographic allocations to an expert. I mentioned that turn in the market last autumn when the vaccines were announced. It's been a long wait for the value style to have its moment in the sun, but it has definitely arrived in recent months. You can see the divergence since the start of the year between growth and value. Economic recovery, rising bond yields and inflation fears are all much better news for cyclical value shares than for the dependable growth stocks which have ruled the roost for so long. So let's look at the main asset classes now, starting with shares. As I mentioned, the real story for equity markets has been in the bond market this last quarter. You can see here how bond yields have belatedly caught up with stock market optimism. Rising bond yields are not so good news for the long duration growth shares whose future profits are more valuable to investors today in a low interest rate environment. But for now, the recovery story is the dominant theme and shares continue to hit new highs. Shares do look more attractive than most bonds right now. This chart shows the spread between the yields on corporate bonds and those on safe government bonds. As you can see, investors' nervousness last spring was short-lived. The hunt for yield and the belief that recovery would be quick has meant investors were quite soon happy to accept only a small yield premium for the risk of a company defaulting. If bond yields are rising and spreads are already tight, then it's hard to make the case for fixed income in a portfolio. A much better case can be made for some commodities exposure, even if, as the chart shows, the prices of some metals have rolled over a bit in the first few months of this year. The case for a renewed bull market in natural resources hinges on the new mood of redistribution, especially over the Atlantic under new President Joe Biden. Putting money into the hands of the lower income households who have a higher propensity to spend extra cash has been inflationary in the past and will probably be so again. Commodities are one of the best ways to hedge against those rising prices. Another decent hedge against inflation is commercial property. It has an advantage over commodities, however, as it pays an income to investors too. As this chart shows, only high-yield bonds come close to real estate when it comes to yield. And that continues to drive money into the sector despite the well-understood challenges for both retail and office property. Okay, let's turn now to the different geographical regions, starting with our own market here in the UK. This long-term chart shows what a perennial disappointment the London market has been, with shares no higher today than they were 20 years ago. The reasons for the underperformance are pretty well known, the wrong sectors and Brexit being high on the list. But for contrarians, that's created a good opportunity. Sometimes the best investments really are under your nose. The market which has left us trading, of course, is the US. Here too, though, you could have done considerably better than just tracking the main market index by tapping into that same rotation from previous winners that kicked in last November. This chart shows the size effect at work. The Russell 2000 Smaller Companies Index diverged from the S&P 500 before Christmas and has delivered excellent returns so far this year. Now, I mentioned commodities before. Well, one of the best ways to play that theme in the equity market is via emerging market shares, which, as this chart shows, have a close correlation with natural resources prices. The dark blue line shows the MSCI Emerging Market Index relative to the S&P 500. It's a close fit with commodities prices, light blue here. The last two slides are markets which are traditionally outperformers as and when global growth picks up. Both Europe here and Japan are markets dominated by exporters, which are exposed to economic growth around the world. The recovery from the pandemic should be good news for European shares, and the region is expected to grow faster next year than this. That should allow European markets to catch up a bit with the US, which, as you can see, has done rather better over the past year. Japan has actually done rather well both over the past year and also the longer term. This chart goes back 10 years and compares the Nikkei index with Wall Street. I, for one, have been surprised at how well Japanese shares have performed. As for Europe, the outlook is good for Japanese exporters, so I expect that to continue.
Okay, well, now we've heard from Tom, let's put some of your questions to him. The first one, Tom, actually the first of a few questions that we had on this one topic is this. It says, given the very strong performance of equities over the last year, and indeed several years now, do you believe that investors should now be taking a more cautious stance? If so, what is the best way of achieving this, given that bonds still appear relatively expensive from a historical perspective?
Yeah, well, I mean, almost by definition, investors should be taking a little bit more of a cautious stance. We've had a pretty amazing 12-month period since markets bottomed out in March last year. I mean, I think on some measures it's been the best performance since the 1930s. I'm slightly tempering that caution, though, because if you look at the valuations of the stock market at the moment, while they are higher, they are by no means excessive. This doesn't sort of feel to me like the top of a bull market. So no, I don't think this is the time to get overly cautious on the stock market. So second part of that question was around bonds and achieving that caution. I mean, I think that's a good question, because I think that bonds are clearly, to my mind, less attractive than equities at the moment. So they no longer provide that balance in a portfolio. So I think if you were feeling a little bit cautious and you wanted to secure the position of your portfolio, then having a bit more cash maybe would make sense at this stage.
Yeah, indeed. Well, the point about bonds, we had, as I say, many questions about it, including this second one, a slightly accusing question, if I may say so, Tom. It says, Tom Stevenson at the last Investment Outlook said that he did not think there was much growth opportunity with bonds. And at the same time, he supported the Fidelity Select 50 Balance Fund. This fund includes 32% bonds, which appears to contradict his view of the asset. Could he explain this apparent contradiction? So, Tom, explain yourself.
Yeah, I mean, it's not an unreasonable challenge. I mean, I am pretty negative on bonds at the moment. In fact, I am probably more negative on them now than I was 3 months ago. But when I think about that Select 50 Balance Fund, and I look at its performance over the 3 years or so that the fund has been running, it's been a very smooth ride. And I look back over the 12 months to March, and I think it rose by about 20%. In the previous 12 months, so the 12 months leading up to that pandemic plunge a year ago, it fell, but by just 5%. So, it's absolutely serving that purpose of providing a smoother ride for investors. And so that, I think, would be my defense. I think, if that's what you're looking for, then it's doing the job.
And I guess we should say here that just because you have a negative view on an asset class, it doesn't mean you need to banish it completely. I mean, you can be underweight bonds, and maybe 32% would be underweight for a lot of people. It's still worth having it for diversification purposes.
Yeah, I mean, let's not forget that is one of the major contributions to a portfolio is that diversification element. So yeah, I mean, I would certainly be underweight bonds at the moment, but maybe not completely out of the asset class.
Okay, well, let's move on, Tom, to the next question, which is this. Given where long-term interest rates are, which is to say low, do we have massive asset bubbles everywhere? If inflation rises as money is printed and interest rates rise, what are the consequences of that? A crash, question mark?
Right. Well, I mean, there are at least a couple of different questions in there. I mean, as for the asset bubble question, there are some signs of speculative excess in small parts of the market. I think some of the new issues market, the IPO, the initial public offer market has had some pretty punchy first day rises, so that's looking a bit interesting. I actually mentioned in the report about the renewable energy sector, which 3 months ago I mentioned this and warned that it was looking a bit frothy, and indeed it's come down. But generally speaking, it doesn't feel to me like a bubble market. This doesn't feel to me like 20 years ago with the dot-com bubble. Valuations are not excessive. Sentiment is not generally too excessive. So no, I don't think we are in a bubble situation. The second part of the question around inflation and the possibility of interest rates rising. I mean, that is a key question for investors at the moment, and we're seeing that with the rise in bond yields. That is a reflection of concerns about the return of inflation and the possibility that interest rates are going to go up. Now, there's quite a step there between that and saying, that there's going to be a crash. I think that actually a rise in interest rates, if it's on the back of a positive recovery in the economy, if inflation is rising for the same reasons but is still at moderate levels, then that can be quite good for shares. It can make shares the most attractive asset class. So I think we're some way off having to worry about those things, but clearly investors should be thinking about them.
Okay. Well, let's move on to the next question, Tom, and it's this. At the moment, there don't appear to be any bad bets, i.e. pretty much any fund or stock one buys is going up. The last time I remember this happening was 2001, and that didn't end well. What are the best options to hedge against a drop in the stock market, and are most funds automatically doing this?
Yeah, that's an interesting question, because actually, I mean, I remember 99, 2000, 2001, and actually everything wasn't rising at the same time. Yes, there was a technology bubble, but there were lots of what we called at the time old economy stocks that were actually not doing so well, and they did hold up much better in the subsequent fallout from the tech boom. And I think that we find ourselves in a similar situation today. There are some parts of the market which have done very well and maybe look a bit vulnerable to a correction. But we've talked about this rotation from growth into value. There are some areas of the market, cyclical areas, value areas of the market, which will do well as the economy picks up. And I think that they actually represent a bit of a hedge against worries in other parts of the market. So I think it's a similar situation to 20 years ago. Actually, there are parts of the market which are at risk and parts of the market which look more defensive.
Yeah, and just on the second point there about funds, whether they'll automatically sort of prepare for any drop like that, it's difficult for a fund to necessarily do that, isn't it? Because they will have their own bit of the market that they're concentrating on, and they'll be mostly preoccupied with making sure they capture the growth that's there. If investors want that option of a sort of hedge or downward protection, they might need other funds to do that job.
Yeah, I think that's a really good point to make, that there are some funds which as part of their objectives they look at managing those movements, the sort of absolute return funds or the sort of hedge fund type funds. That's their job. But other funds are designed to give you an exposure to an asset class or a geography or a particular style of investment. And I think it is up to you, and that's where we can come in and we can help with our commentary to help people get the right balance of those different funds to achieve the goals that they're trying to.
Okay. Well, let's move on. The next question actually starts with a bit of a gloomy prediction. Some investment advisors are warning of a great crash in 2021 due to extremely high valuations. Is this likely to be across all sectors or limited to the overinflated tech sector? Could such a crash in one sector create a domino effect to, say, value sectors, even though those look cheap and set to perform well in the forecasted economic conditions? Well, do you share that gloom, Tom?
Yeah, no, not really, and we've sort of addressed these points in an earlier answer. Actually, I mean, I do think that we are in the middle of a rotation away from growth to value, and that is a reflection of what's happening or is likely to happen with the recovery and with interest rates and with bond yields. So I see that continuing. So, I would probably be looking to rebalance a portfolio more towards those more cyclical areas of the market, and indeed the funds which are exposed to those more cyclical value areas of the market than growth. But even having said that, I wouldn't go all in with value, because if things don't work out quite as well as we hope, and interest rates don't rise and bond yields don't rise, then actually there's a lot to be said for investing in those growth sectors, those technology sectors, for example. So I think, as ever, and I say this a lot, but having a balance between the different styles is important and makes sense.
Okay, well, the next question is kind of related to this. It says, US equities have done very well so far this year. However, is the S&P now overpriced, and should investors be looking to other markets for returns? What do you say, Tom?
Well, I think the S&P 500 is more highly valued than many other markets, but I think there is a good reason for that. I look at what's happening with the fiscal stimulus in the US, under the new Biden administration. The government there is throwing an awful lot of money at the economy, and I don't think you should stand in the way of that process. There's this old saying about don't fight the Fed. Absolutely, if the Fed, the central bank, and the government are both pulling in the same direction, then it's quite risky actually to take the opposite side of that trade. And so I think that there's a good reason for the US market being reasonably highly valued. I think the next 2 years look pretty impressive in terms of growth, economic growth, and the follow through from that will be corporate earnings growth, in my opinion.
Okay. Well, next question, kind of on this topic of growth to value, Tom. It says this: Hi, Tom. We have seen a lot of volatility in stock pricing recently, with a sudden switch of favour from growth to value. Is there anything the platform, which I guess means us, can do to give better insight into these potential market switches before the event? As a working individual, it is hard for me to be on the ball all the time. I would have moved some funds around to buffer the effect to some degree had I been more alert to the likely change. So is there more people can do, Tom, to spot these things in advance? I suspect that if they was and you knew what they were, you wouldn't be sat here talking to me. But
yeah, I think that's probably true, and I hope that that's what we do. With our commentary on the website, in the podcasts, with the market updates that we do every week. I hope we try and keep tabs on these slightly longer lasting trends and to catch them, if not before the event, then at least as early in the transition as possible. So good question, but just keep reading our material, and hopefully we'll do what we can for you.
Yeah, and I would add there, I mean, a lot of these things do look very obvious in hindsight. There were, of course, predictions about growth to value, but there have been those predictions for many, many years. And so it seems that it's taken root now, in a way that it hadn't done before. But the answer, as it so often is, Tom, I guess, is to do with diversifying your assets, so that when these things come along, you capture a bit of it, maybe not all of it, but you are exposed to those potential upswings.
Yeah, I mean, absolutely. I mean, let's just look back 12 months and remember what the world looked like last March. And, hindsight is a wonderful thing. And the market has gone up enormously over the last 12 months. Certain markets have done much better than others. The US has done much better than the UK, for example. It's one thing seeing it now. It's another thing seeing it, ahead of time.
Yeah, indeed. Okay, well, let's move on. The next question, Tom, is this. It says, I note that you're going to cover the increasing risk of rising inflation. I guess that means in your commentary, Tom. I would be keen to understand how one can position their portfolio in order to minimize the impact of rising inflation were this risk to materialize.
Yeah, well, we've touched on this already, and I talk about it in the report. I mean, clearly, some asset classes are better in an inflationary environment than others. You know, the one to highlight, of course, is bonds, fixed income, which is notoriously bad in an inflationary environment for kind of obvious reasons. You know, the returns are fixed. So if inflation is rising, then they are eaten away, they are eroded by inflation over time. Shares are a much better hedge against rising prices, because companies have the ability to raise their prices alongside the rise in inflation. Other asset classes are also pretty good hedges. I mean, I've talked about commodities. I think there is a fairly strong argument for a bull market in commodities, in metals and in energy. So to the extent that you can get a bit of an exposure to commodities alongside shares and minimize your exposure to bonds, or slightly reduce, under a sort of natural weight in bonds, I think that probably makes sense.
Yeah, and I guess, as well as those asset choices that you might make, I suppose you might just have to get ready for a bit more volatility if this comes along, and this sort of rotation and higher inflation. It's going to have all sorts of implications, and you need to be ready for that.
Yes, I think we probably do face more volatility. If you look at the VIX index, which measures volatility, it is standing at very low levels, and it does move up and down. So typically, when volatility is low, you should expect it to rise. And I think that we are in a particular sweet spot at the moment. We've had the good news on the vaccines. We've got the recovery coming through, and often it is better to travel than to arrive. And the expectation of good times to come in 6 months or a year's time is a sweet spot for markets. When the good news actually starts being delivered, investors have already moved on to looking at what lies beyond that. So let's enjoy it while we've got it, but be prepared for a bit more volatility in future, I suspect.
Okay, Tom. Well, let's move on. The next question says, "Hello, Tom. You're always advocating diversification. I think that probably means, and diversity. And I believe my holdings are very diverse. However, if I examine my portfolio for overlap, it is quite considerable. What methodology have you for maintaining good diversity, but avoiding clashes of overlap?" So I guess that means, how do you avoid having lots of funds that are doing the same thing, covering the same companies in the same part of the market?
Yeah, I think that is the implication of that question, because I mean, on one level, getting diversification between different asset classes and between different geographies is relatively simple. You need some US shares, you need some Japanese, some European, some UK. That's not difficult to do. But when you look under the bonnet of what's actually in the funds, you may be surprised actually at how much overlap there is. So I'm afraid there isn't really any alternative to actually, the hard work of going in and looking at the main holdings of the funds. It's quite easy to look at the top 10 holdings of funds, and very often the top 10 holdings represent 40 or 50% of the total value of a fund. So it's a good guide. And it's worth doing, because if you had a couple of, say, UK equity income funds, for example, you might find that they had a great deal of overlap. They will hold very, very, very often the same sorts of stocks. So if you think that you're diversifying by just having lots of funds, you may not be. So it's a very good question.
Yeah, it's an interesting one, this. I guess, as you say, it isn't always possible to see exactly what a fund holds. It's not really typical for funds to publish all of their holdings, but really at an investor level, certainly for the sort of ordinary investor, they probably shouldn't get too hung up, should they, and try and look more in broad terms to make sure that their funds cover discrete and specific areas of the market. Check the investment philosophies that are often published along with the fund, so that broadly the region, the type of company, the size of company. Details like that will help you put together something that isn't clashing too much.
Yeah, I think so. I think if you're diversified by asset class, by geography, by size, and by style, then you're going to be pretty well diversified.
Yeah. Okay, well, the next question, Tom, is actually related to that. It says, regarding your new ISA picks, having generally followed your picks over the last few years by adding another 4 or 5 each year, I guess, I might end up with nearly 30 funds. Is that too many? Should these replace some of your previous picks back in, say, 2017, when the world was very different? So there's a question there, Tom, about now versus 2017, but also about how many funds is the correct number.
Yes, and maybe 30 funds is too many. Although I'm probably not far off that myself. So in terms of the time, though, this is a really interesting question, and I addressed this actually in the report this time, because I look back over the last 4 years at the fund picks that I've made each year. And I'd be quite wary of just getting rid of picks because they are, 3 or 4 years out of date, because you don't know which fund is going to do better than the others. That's the diversification point. But you also don't know when it's going to do well. So, a good example was Fidelity Special Situations, which I recommended 4 years ago, as well as this year, actually. It spent a long time going nowhere, actually being a bit underwater. And then suddenly, over the last 6 months, it's performed fantastically. So you needed to wait. So just getting rid of it because it was 3 years out of date would not have been a good idea. So actually, I think there is merit in holding on to these picks.
Yeah, indeed. Well, and on that point about how many funds is the right number, it kind of relates to what we were saying before, that you need your funds each of them to have a sort of distinct job in a portfolio, don't you? And ensure that they're not too overlapping. And the danger, I guess, with having a great many funds is that you over diversify and you basically invest across the entire market through lots and lots of active funds that might be a little bit more expensive, and all you're doing is just recreating the effect of the market as a whole. And well, it would be cheaper to do that via a tracker fund where the costs are very low. You're going to get basically the same exposure, right? Yeah,
that's exactly right. Yeah, I mean, if that's what you are doing, if you're so diversified that you're effectively doing the same job as buying a global tracker, then that would be a cheaper way of doing it. No, you're absolutely right. There is this expression, isn't there, diversification as opposed to diversification. There is some truth in that.
Okay. Well, Tom, let's move on. A couple of questions on a particular topic that I think you've picked on in your outlook as well. The question is, what are the best funds for an investor who wants to minimize exposure to fossil fuels while meeting other basic ethical requirements? And I'm going to lump in the second question here as well, which says, do you believe it is possible to build a diversified portfolio of sustainable impact funds for an investor wanting to make a positive impact on the planet and society with their portfolio?
Yeah, I mean, absolutely, it is possible. There's a lot more focus than there was in the past on environmental, social, and governance issues. What we call sustainability. And indeed, in my fund picks this year, I had a specific focus on them. With at least 2 and possibly 3 of the 5 funds that I picked having an explicit focus on these aspects. Just the other point that I was just going to make is that we're constantly trying to develop our website and make it better and more useful for investors. And so I would just say to people watching this that we've got some big plans which hopefully will come to fruition very soon on sustainable investing, and we're hoping to provide a tool which will really help people make those choices and align their investments with their sustainable values. So watch out for that. It's coming soon.
Yeah, indeed. It's probably worth saying on this subject of ESG, environmental, social, and government investing. it's an area that's developing, isn't it, Tom? I mean, we as a company and companies like us are sort of working out ways to narrow that universe down for people. The asset managers themselves are developing their approaches to it. It's going to develop, and I think in this phase that we're in, as it develops, people are going to have to do that work themselves a little bit as well. You know, understand what a fund is doing, see whether it really matches up with their expectations and what their own personal values when it comes to ethical investing are.
Yeah, it is. It's a work in progress, and when things are new, you need to be careful. You need to make sure that the funds that you are investing in the belief that they are strong on environmental, social, and governance factors really are. And you know, there's this so-called greenwashing challenge to the fund management industry, and I think that as investors, we need to look at that very carefully.
Okay. Well, Tom, let's move on. A number of experts, the next question says, including your good self, promoted Asia as a possible area for growth during 2021. So far, though, based on the funds I'm invested in, at least, returns have been pretty flat. Do you remain optimistic on Asia, Tom?
Yes, broadly speaking, I do. I think we've talked a little bit about this idea of being first in, first out, being better to travel than to arrive, and I certainly think that, you know, investors in Asia and China in particular are starting to look, you know, through the recovery to maybe the tightening that comes thereafter. However, you take a longer term view, you know, the structural advantages of emerging markets, particularly Asian emerging markets, absolutely remain intact. So a diversified portfolio would obviously have a significant exposure to those markets.
Okay. Well, Tom, next question, a bit of a tangent or change of pace, more of a financial planning question, I guess, and simple as well. For retirement at 60, what percentage of drawdown is sensible? Big question.
That's a very interesting question to me, and I think that, you know, my conclusion is probably not a million miles away from the sort of conventional wisdom on this, which is that taking 4% of your portfolio out a year is probably sustainable. It's something that you can replenish the income that you're taking out with capital growth and income within the fund. Anything more than that, then you're at risk of running down your fund too quickly. 4% feels about right to me, but you know, let's just repeat your comment at the top of this video about this is not advice. You know, it's so important. This is a really important decision when you get to that stage in your life when you're turning your savings into income. You know, it's a really good time to take some advice.
Yeah, it's a short question, this, but it's absolutely it's an absolutely massive subject. It's something that people are going to be wrestling with increasingly as the years go on, and more people are living off invested pension pots. You mentioned the 4% rule there. That is a rule of thumb, and it's important to say that whatever you personally think you can draw down from a pension pot, you need to keep an eye on it. You need to have a plan which has flexibility to say, well, that may be the starting point, but I am completely dependent on what markets are going to do year to year, and I'm going to have to adapt as I go along in terms of the amounts that I withdraw. And a very, very crucial thing to say here is that you have investments that you hope will grow, maybe produce income, but the cash savings that you have are really, really important in that scenario, aren't they, Tom? Because in reality, what retirement planners will recommend is that you keep as much as a year, 2 years, or even more worth of income in cash. You actually use that pot of cash for your day-to-day living, and then you've got investments, growth assets behind that you will hope grow in value and can replenish your cash reserves. And why that's important is that if you do get bad years in the markets, you've got a bit of time to let your assets recover, and that's the kind of flexibility that we're all going to need to build into retirement plans.
Yeah, absolutely right. You said it very well there. I mean, yeah, making sure that you are not exposed to the market in an adverse way is really important when you start moving into that income generating phase of your investment life.
Indeed. Okay. Tom, so let's move on to, well, the UK, and which is obviously going to be of relevance to lots of viewers of this video. Are UK funds undervalued at the moment? And if so, what type of fund would you recommend, Tom, as a good recovery play for this year's ISA allowance?
Yeah, short answer is yes, I think the UK is undervalued. It's been out of favour for many years. For good reasons that we've talked about at length, Brexit in particular. I would draw attention to my fund picks this year. The UK recovery in the UK was one of the key themes of my picks, and I had two picks because I was unsure about this growth to value rotation. So the Fidelity Special Situations Fund and the Fidelity UK Select Fund, both Fidelity funds as it happens, are a way of playing that UK recovery, but with a focus on both growth and value.
Yeah, and to flesh that out, Tom, it's the Special Situations Fund, which has the value skew of those two. Also has a sort of mid-cap or slightly smaller company bias as well. So that would suggest that you're going to get companies which are making more of their money, relatively speaking, in that UK economy, if we believe it's going to recover well. And then the Select Fund is the more sort of perhaps more global looking, larger company, high quality company fund.
Yes, I mean, it's very much got a UK focus, but it is a more defensive play than the Special Situations Fund. Yeah, that's true.
Indeed. Okay, well, Tom, that is all that we have time for now. Thanks for joining us today to answer all those questions. If you're watching this and you had a question that we didn't answer, we will have, as well as this video, a special edition of the Money Talk podcast, which will answer yet more questions. You can listen to that on iTunes or wherever you get your podcasts. A full copy of Tom's Investment Outlook is also available to download at fidelity.co.uk/outlook. Thanks so much for joining us today and watching, and do join us again next time. Bye for now.